Good afternoon, everyone, and welcome to Stock Market Today. It's Coram and Ed Carson here with a breakdown of the action in today's session, where we saw more damage suffered for the major indexes, with them breaching a key technical level today, Ed.
Yeah, not good action out there. I want to take a look at a couple of stocks that definitely showed some of that weakness: Antero Resources and Steel Dynamics, but also looking at Pinduoduo, which has held up reasonably well.
We will check out those charts, but first let's take a look at the major indexes. The Nasdaq down 1.1% by sessions close. Same for the S&P 500, followed by the Dow down a little less than 1%, but it looks like small caps the hardest hit today, with the Russell 2000 down some 1.6%. And Ed, this just goes to show how so much can change in just a matter of days here. But a couple of the technical levels that we were concerned with holding going back to when this rally was still quite strong, we've now just slowly chipped away at all the levels that we've been wanting to hold above and haven't been able to do it.
No, we really haven't, and that's just the concern. There was a concern all along: was this a bear market rally? And it looks increasingly like that. Ever since the S&P just barely came short of the 200-day line,
Right.
a couple of weeks ago, it's been pretty weak. Yeah, there's been a day or two that things have held up, like last Thursday, but that was just sort of like the eye of the storm kind of thing, and right
Yeah.
before Fed Chief Powell, and ever since then, right through the 21-day line in heavy volume. All the major indexes are below their 50-day line. Leading stocks, recent breakouts have almost all failed.
Mhm.
Yeah, you're going to find some that held up, but then there'll be like stocks like Steel Dynamics, which we'll look at soon, that hold up and then they don't. And below all these levels, so now we're coming into these things. Yeah, all these different levels that we done well. There's the 12,000 level. The S&P and the Dow had some round numbers as well.
Mm-hmm.
So it's just increasing pressure. I think that investors, should need to be cutting exposure, even if you're not thinking about your portfolio, just looking at individual holdings. Chances are, if you bought anything over the last 2 or 3 weeks, either big gains have turned into small gains, or small gains have turned into losses, or some very recent buys may have turned into, some significant losses. Those are reasons to cut back or get out of those positions entirely.
Yes, exactly. But when we were seeing the major indexes with this strong rally coming up to key potential resistance, because it's great to talk about defensive selling, but also I think having that offensive selling and making sure that your exposure isn't getting out of line when we are seeing those signs that, hey, we're not in the clear yet. Can we get above and stay above the 200-day line? That was kind of the first warning sign. Of course, we couldn't anticipate it playing out exactly how it did, but every step of the way, when you're keeping an eye on those key levels, this brings me back to the Mike Webster days. I mean, how many levels up and down was he looking at and keeping tabs on every day? But to me, that's just having good guardrails for, okay, what level are we at? What should my exposure be? Should I be getting more defensive, instead of all of a sudden not doing anything until we get a break of the 50-day? I think that just puts you in a different position in your portfolio and mindset as well.
Yeah, and I think the point about when things were going well, we weren't saying sell, 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 but we were saying, well, maybe you want to hold off until we get a little bit more strength, that we decisively break through, just sort of like not put on the brakes, but just sort of take your foot off the gas a little bit and see how things go. And as it turned out, things pulled back.
Right.
Now, could things turn around? Sure, they could. Or we could be range bound. I mean, we could be between here and the old highs, or between the recent highs and the June lows. That would not be out of character with some other bear markets. Sometimes it takes a while to digest that situation. 2020 was so bizarre. This knife down almost immediately, then knifing back up. That's not really that usual. So, especially with the Fed continuing to tighten, it's not easing off, because the Fed in 2020 was slashing rates. In 2018, 2019, they reversed course and cut rates. This time they're going to keep raising rates. So there's not going to be that easy push that we've seen in the most recent recession bear markets.
Exactly. Yeah. Great to have that context and to keep that in mind. And yeah, making sure you're not pressing the gas too prematurely, or and not immediately slamming on the brakes. I think easing on those brakes, but also we were saying maybe lock some profits into strength. We haven't been wanting to chase breakouts. Still, it seems like selective buys, early entries, taking quick profits. Those are all things that have helped protect investors for this very tricky environment. And it seems like we will know when we do have the wind at our backs, because it will be a lot easier. So it constantly, having that market feedback is something that can be very helpful in guiding our portfolio decisions and listening to the market's feedback, not only getting the feedback, but listening to that feedback as well. All right, well, let's check in on the 10-year Treasury yields, Euro T and X here. Looks like not much action today, but still above that key 3% level.
Yeah, and it came off intraday highs. Some of the shorter term yields did keep rising, a little bit more sensitive to the Fed. There's not so much that the December rate hike, they're still seeing a 75 basis point hike, and there's just more and more locking in even continued high rates that will get to about a 4% rate level at the short-term level, which that's probably suggests a lot of other rates are going to move up as well by year end. So that's something that's really been weighing on the market. And obviously the trend on Treasury yields, even the 10-year, still very strong.
Yes. Absolutely. Okay, well, let's just a quick check-in on some of the sector action today. Energy stocks and commodity stocks broadly taking a pretty hard hit today. XLE down about 3.4%. XME, the metals and mining ETF, even worse, down 4.3%. Chip stocks, some bleeding there, but not quite as bad, but still off over 1% today. Any thoughts on the action underneath the surface today, Ed?
Yeah, I mean, this explains some of the breakouts that have been failing, some of the action, and some of the chip names, like the ones that are doing really well, they were hardest hit, some of those. So there's just a lot of across the board, there's weakness. And so the leading stocks being weak, not the chip sector, but some leading stocks, just shows you that, real problems for the market rally.
Mm-hmm. Okay, well, Antero Resources, ticker AR, round tripping an early entry just above the 40 level. Today, down over 8% in some above average volume. We were seeing a lot of energy stocks forming the right side of bases and breaking out. But today, a number of them looking like this and suffering quite a bit of damage. This has been the area that has been holding up better than most, Ed.
Yeah, so that's when one of your pillars is not doing well, not great. And not only did it go below the 4105, but really that day where you could have sort of broken the trend line, would have been really hard, just a downward slope kind of thing. You'd still be down even off of that, basically, like anything, just really wouldn't have been able to get into that stock. So even from that wiped out, it's just really tricky. And again, yeah, it's so hard because you run up for a few days or a week or two and then come down. Yeah, could this come back? It's not broken. It's not a broken stock. It could rebound or, that it does have an official handle. It could come back up. But it just shows you how difficult it is to get sustained gains, really meaningful gains before seeing them come right back down.
Yeah, you're right. Maybe this is just the continuation of a handle and an actual shakeout here, because up until this point, the last couple of days haven't been much of a shakeout, but we are getting that now. We'll have to see if there is going to be more damage for a number of the stocks that look like this, if they can stop at the 50-day line. Ed, do we need to be keeping our minds open for the potential of, hey, if bounces off the 21-day line or these early entries on the right side of bases didn't work, maybe we'll get some bounces or reversals off of the 50-day line? Or is it too premature, given the broad market weakness, to be thinking about that?
Yeah, I mean, it's hard to do that, and especially if it comes straight down. Like if this falls
Sure.
like whatever percent it is, it's like, man, that is really sharp. I mean, those things can happen. The energy price spirals back up, and this would go back up. So those certainly could happen. You just have to remember, this is why the shakeouts are so effective. Look at that. If you're down, gains have been wiped out. There's reasons why shakeouts work. When they turn around and go back up, they go, oh, I wouldn't have been shaken out, but this thing could keep falling, and you just have to be open-minded to the fact that it could rebound. So it might set up again, or it might bounce back, but you have to be open to the possibility that this keeps on getting worse. This is just probably not actionable now. You want to be stepping away from it now, and then seeing what comes next.
Yes. And let's take a look at steel dynamics, an expectation breaker here for this recent breakout, with a decline of about 5.6% today in above average volume. But just a couple of sessions ago, we saw an above average volume breakout for steel dynamics, but not looking so hot today, with it coming back all the way down to where it was on this reversal at the 21-day.
Yeah, so that gain is all wiped out. So it's not just the buy point, but wiping out all that gain. Yeah, so stocks can hold up for a day or two, or sometimes even longer, and then suddenly they snap. And that's just something you have to watch out for. So even if you have stocks that are holding up right now, you have to be thinking, well, do I really want to hold on to it, or do I want to hold on to all of it? This one obviously showing weakness, disappointing, but there's not a whole lot of stocks that are holding up.
So, Ed, for those who maybe bought before it technically cleared the handle entry just above 86, would you be completely exiting on a day like today, or would you sell and then sell part of it and then wait for a more definitive close below the 21-day?
Yeah, if you bought really early on that day, I'd be at least cutting the position, and I think with this market, you might want to just be saying, to heck with it, I'm out, because the upside seems limited, and the downside could be quite a bit. So there's that as well. So the market would probably get me all the way out, but I'd at least get probably halfway out.
Mm-hmm. Okay, and maybe there's a little bit of a bright spot in some China stocks, well, at least for PDD, Pinduoduo, which we did see test a breakout from a bottoming base on a strong earnings report, a lot of volume on the upside coming into this stock, and it managed a positive close today with more heavy volume coming in. And this is a stock that has put up some strong numbers as it tries to bottom.
Yeah, so this is looking strong. It's really extended from the 50-day line and 200-day line. It'd be nice to see it form a handle. I think one concern is that this is sort of the only one. I mean, Pinduoduo, its e-commerce rivals aren't doing well. Baidu, which is, it's sold off today. EV stocks are selling off and struggling. So, I mean, I know this is Pinduoduo, but you could say if it's Pinduoduo, it's really running solo. And so there's... that would be an issue, is that, to be a lone wolf has not been a great survival tactic in this market.
Lone wolf China stock, which we
China stock,
we talked about the added risks that can come with this part of the market. So, but it is showing that relative strength, and we got to keep an eye out for the stocks that are showing relative strength in a weak market and setting up potential buy points. So I think on that note, Ed, it seems like as investors are scaling out of their positions, maybe, don't run for the bunker, but keep a lookout for those stocks that are bucking the weakness, holding up against this downdraft right now. What do you think?
Yeah, look for stocks with strong relative strength. And, we still don't know. The market could bounce back. It's not broken. It's not this, and we're not in June yet. I mean, I'm not saying we can't get there, but, so you have to be ready to be looking at that. You might build the watch list knowing that things might still be actionable in a few days. And if not, you want to be building the watch list for the potential leaders if it takes a while to get there.
Yeah. And in the meantime, we will stay flexible and open-minded to all scenarios. Thank you, Ed, for that breakdown. And thanks everyone for tuning in. We will be back with more tomorrow morning on IBD Live, and we hope you join us, investors.com/IBD Live, for all the details on that. And we'll also see you right back here tomorrow after the close.